Hi everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today I'm going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topics, sectors, looking for investment opportunities and sharing those opportunities with everyone in the community. Special is the coupon code, get 50% off the first month only on a monthly membership and a larger discount on the yearly membership. And you can always switch from a monthly to a yearly. So starting out here, this divergence is rare, and it's suggesting a stress ahead for equities. CHF is the top safe haven fiat currency. So what he is showing here, and I think a lot of people underestimate, or maybe they don't understand what's really going on here. So it says very close to a 2007 market top, 2011 market top, and today a very similar fractal setup that could be very close to a market top. And on the bottom here, we've got the S&P 500 priced in Swiss francs. What does that mean? Why does that even matter? Well, there's a couple of things that stick out to me in the current market conditions. One, we know that the S&P is overvalued in relationship to commodities. When commodities outperform, what you generally see is the outperformance of emerging market currencies and other currencies like the Swiss franc against the dollar. Now, this one is just showing it against the S&P 500. And the S&P 500 is an extension, in my opinion, of dollar strength. So what happens is that when the dollar is strong, money flows into dollar-denominated assets. When the dollar starts to weaken, or when things start to top out, like maybe these three areas and the fractals are similar, you start to see some things shift underneath before the S&P 500 turns and tops. This is one of those things that you see before a top. You start to see currencies start to move differently. Maybe the DXY starts to go potentially into a downtrend. It's about to break support levels. And these are early signs of the divergences that you could potentially see, like the S&P 500 in the Swiss franc. So these are things that they're little key things in the markets that show up that people aren't paying attention to. Now, am I stating that this is the exact top? I don't know. I don't know if it's the exact top. All I'm going to say is I'd be watching for it. Because the key little traits that people don't pay attention to, well, those could be turning over in favor of a potential top. Now, again, I don't know for sure, but they're just things underneath that we want to look at. Now, would I be in the S&P 500? No, I wouldn't. I'd go buy commodities. They're cheap. That is my safety. That's my margin of safety in the market. I may be wrong for a period of time where I underperform the S&P 500 in certain areas, but that doesn't mean I should be there. And I don't think people understand what that means. Just because something outperforms another asset class does not mean I should be in it. And a lot of people, what they do is they just run around trying to chase price performance. If something is overvalued, I avoid it. My margin of safety is not there. That you're just speculating that the price is going to go up, and you've got zero margin of safety. You're buying an overvalued asset, hoping, praying that it becomes more overvalued. You're overpaying for an asset, hoping that it gets more overvalued. That's just not the playbook. Doesn't work very well on a statistical basis, unless you're short-term trading. And I don't do short-term trading. Coming down, the jaws of stagflation are wide open per Bloomberg. And what is this? So this is the jaws of stagflation are wide open. Employment and prices paid. So we've got prices paid increasing recently, and employment looks like it's on the lower end here. Are we going to get further unemployment and our price is going to continue higher? What does that look like? I would suspect that gold and silver would be a benefactor in this type of situation. What do we see in those charts? So everything that we see here, it is all interconnected. This is interconnected with this. And this, being in a stagflationary environment, is interconnected to, well, we've got the dollar here, which I pulled up, but let's do XAG USD. That's also interconnected with these big long-term charts of the cup and handle, which is interconnected with the 10-year yields. So when people look at all this, and this is about to break here, this means that stagflation is a high probability. That's what this chart is telling us. That's what this chart is telling us. That's what this chart is telling us. They're all interconnected. And if we do get something like that, now this is where I get confused. I don't know which way the dollar is going to go here. Now, a lot of people are speculating that we're going to have to devalue the dollar and do that and have to do maybe QE and all that. And that could be the case. And we could get this thing to drop and we would get a bull market in commodities, commodities, commodities. And then if it drops, more than likely we're going to get a bull market in commodities. Why? It's all currency exchange rate related. All of it, guys. Commodity bull markets are currency exchange rate related. It's the currency dropping. And then the whole commodity complex goes up and gets revalued higher because stocks and bonds underperform during some of these periods. Bonds for sure. Sometimes stocks and commodities can go up together. Other times they do not. They track sideways while commodities rip. And I don't know what, I'm in the camp that it's going to be commodities are going to go sideways and the stock market, the S&P 500 is going to trade sideways and commodities and precious metals are going to rip. I think it's going to be more like the 70s than these other ones. And that's solely due to the US 10-year yield breaking out of its downtrend here. So I think that this era here is more like the era that's coming. And this era that's got the downward arrow is more like this era going down. Now, that does not mean that we go up the entire way. It just means that we cycle. We might have cycles of stuff that cycles up like this, where we cycle on up over time. That's commodities or precious metals, whatever it is. And that's exactly what we saw in history, is silver cycled up with interest rates. And that was the lack of money going into that. Now, it doesn't mean that the S&P 500 goes down the entire time, but we are in an overvalued area. So here's the S&P going up here. You can see we went sideways for a pretty long time here in the 60s and 70s, all the way to 80. And we still made decent progress here in the 40s and 50s. So this was pretty good down here. And then it got a little funky as interest rates hit a certain level and we started trading sideways. So that could happen again, where the stock market does well and interest rate, until interest rates hit a certain level, and then we start getting a little funky with the stock market. And that's what I think is probably going to occur. I think that oil is approaching a major bottom, and I expect oil 2 years down the road, in let's say 2027, I expect oil at $150 to $200. So that could be a very interesting play, says Felix Zulauf in one of his interviews. I agree with him. I think that's going to occur. And I think we could go even higher. We'll see. We'll see what the inflation's like at that time. Jim says, following Buffett into Oxy sounded smart until you're sitting on a 27% loss while the market runs away without you. Don't chase, know your risk, know what you own. And this kind of seems to me kind of stupid. Uh, you're going to go buy an overvalued asset in the S&P 500 as it runs away from you, but you view Oxy as risky. Um, so Buffett went into Oxy in the 60s just because don't buy a stock just because someone else did it. Do your own research, understand the business, know what you own and why you own it. I don't know why he's saying this and saying at the same time while the market runs away with you without you. There are correct decisions and then there are bad decisions. So if I'm playing poker and I've got pocket aces, usually I'm not a big poker player, but usually you want to bet bigger. You want to try to get people out because you have a favorable hand. So you may bet more aggressively as long as you could be playing the game too. You might not bet aggressive in the beginning, or maybe you do. It depends on your strategies, but you have a good hand statistically. So you're going to play that hand. You're not going to play that hand if you have a mismatching 2 and 5, right? So they don't match. You got a 2 and a 5. You're not going to play as aggressively as you would perhaps with pocket aces. Now, just because the outcome after the fact, you lose the hand even though you have pocket aces. So pocket aces does not mean that you're a guaranteed win. But what it means is that statistically you have a better chance of winning than you would with, say, a 2 and a 5 offsuit. So it doesn't guarantee the win. So when I look at this, it says following Buffett into Oxy sounded smart until you're sitting on a 27% loss while the market runs away without you. Well, that's in hindsight, number one, because you're looking backwards. And number two, Oxy and the way that it's valued is a far better value to purchase than it is in most of the companies in the NASDAQ or S&P 500. When you look at price to book, price to sales, price to earnings, and all those things. And we'll look at what those look like later. So did Warren Buffett make the right decision given the hands that he was dealt at that time? In my opinion, yes. Yes, he did. But in the short term, he didn't win, but he's still playing the odds. And that's where people, and I don't know, like, it doesn't make sense to me. There's a lot of people that talk like this. And to me, I'm like, well, he's playing the game you should be playing. I mean, to me, this reads as someone who doesn't understand statistics. He doesn't understand anything. Like, he's math dumb and 2020 hindsight smart. It's like, well, no, duh. So what would I gain reading this? That Buffett made a wrong call, that people who went into Oxy made the wrong decision because it's down 27%? Is that a bad thing? What if I said that most entries at some point, if you're buying at a very low price, that most entries will be down on you at some point? That the majority of stocks that you own in the beginning will be negative at some point when you purchase it, when you're playing an undervalued game. Does that mean that it's a bad purchase? And then what if you held that stock for 10 years and you made 10,000%? But in the beginning, you were down 27% when you first purchased it. It all looks stupid to me then. So in my question then becomes, how much does Jim know about investing? Does he know anything? Because if you're buying at the beginning of, say, a raging bull market in commodities, why would Oxy be a bad purchase? Now, I'm not purchasing Oxy. I'm buying other companies that are smaller than Oxy that I think have more leverage. But I think the 27% loss is immaterial. I think it's an argument that isn't a valid argument. Because if no one can pick perfect bottoms, at some point you're going to be down on a lot of what you first purchase if you can't pick perfect bottoms. So what is he saying? Don't buy anywhere near the bottom. Wait until it goes up and then buy into strength, even though you might have to wait. You may not have as good of an entry point. I don't know. I don't like this comment. It rubs me the wrong way here. It really does. Garrett Goggins says the gold bull market will have a roof of silver like other major peaks in 1980 and 2011. Silver needs to rise to $70 an ounce, a 60% premium to gold, to mark a top. We aren't there yet. Well, that doesn't mark a top. What that marks is a more fair valuation for silver. But that's also holding gold steady. I mean, we just looked at this chart here of how we're about to break out of this massive cup and handle pattern. And I think that maybe 60 is a point where we could pause, which is like right in this area here. And that's the same fractal as the 1970s. So what I did is I moved it over here and squeezed it up for the time frame that we are seeing and overlaid, I would say, important critical areas of the chart. So I think we could pause at 60, but I still think we're going to have another leg higher after that. Things move and then they pause, and this is when oil is going to run. It's going to run in here when this silver pauses. So I think silver will move first, and it could do it very rapidly and quickly, and then oil is going to run for a more longer burn. That'd be my guess. But would I sell this off a breakout here? No, I wouldn't. There's no way I would sell this. So would this be a top? You're going to see a lot of people sell at 60, 60, 70 bucks. Yeah, totally. And they're going to think it's a top, but they're going to be too early. Too early, Junior. Coming down, this is absolutely crazy stuff. NVIDIA's weight in the S&P 500 is now a record 8.2%. This is more than 3 times the entire energy sector, which consists of 25 stocks. At the beginning of 2024, NVIDIA's share in the index was 3%, comparable to the energy sector. So their energy sector is doing this while this is going up. You know what I say? Bubble. It's in a bubble. Now, is it the top? I don't know. But it's in a bubble. And would I buy energy? I would. That's the smarter play. Why? Because it's pocket aces. This is 2 and 5 here. The deck is done. Like, you've already got the winnings out of this entire deck. All of the great cards are gone. Coming down, Michael Hartnett of B of A posted this chart of the S&P 500 price to book ratio. This won't tell you when the market will drop, but it will tell you what floor you are on when it does, and you're at the top floor. The market is done. It's expensive. 2000, 2025, 5.3. It's the most expensive time going back to 1946. Hell, 1968. Look at the valuation difference here. This is probably a big double top here. Big double top. And then I think what comes next is going to be the largest commodity bull market that anyone's ever seen. And money's going to rotate out of the bond market and out of this overvalued stock market. Similar to the 1968, but look at the valuation difference. We are well over 2 times more valued than 1968. This is coming from a ludicrous valuation level. It's all part of the cycle. A 40-year decline in interest rates from here to here, this US 10-year, this is what drove everyone into financial assets. Do you get it? Financial assets, 1941 was the bottom of those rates. Here, 2020. So usually what I think you're going to see is everyone was driven into financial assets down here, and that's going to rotate over. It's going to rotate back into other things later, and it will. We just got to get this cooking higher with interest rates, and then the rotation will come. There are now 511,000 new homes for sale in the U.S., the highest inventory since October of 2007. Why is the home builders rocketing higher here? And this is U.S. new single-family homes for sale, 2007. If interest rates drop, what will this look like? I don't know if this really matters. If you're in the middle of a bull market, and let's say we were going into a large expansionary phase, wouldn't you have a lot of new homes for sale? I mean, wouldn't it matter if, I mean, is this inventory levels? If it's inventory level, then yeah, maybe it's a problem, maybe it isn't. Depends. It says Rick Rule rhetoric. If I'm right about the next 10 years and the purchasing power of the US dollar declines by 75% and the gold price mirrors it, that would suggest that gold prices rise fourfold. He knows what's up. The decline of the dollar is what's repricing commodities and gold higher. It's my DXY chart falling, just like all the other bull markets. So bull market in commodities, bull market in commodities, bull market in commodities, and then we're going to get another bull market in commodities. That is what this means. The dollar declines by 75%. Warren Buffett added a whole bunch of shares of Chevron. So what is Warren doing? What does he know about the cycle? Let me look at some of these stocks. And you know what? They're the same stocks and sectors that we are buying. He's buying different companies. They're larger companies because he is constrained to what he can purchase, which is big companies. He's got so much money. So look at Lennar Corp. He added massively. Do you know why? I think they're going to lower interest rates. They're going to drop the dollar, and home builders are going to soar. That's what he thinks, I think. He's got Chevron. That's an oil company. Nucor is a steel company. Why is he buying steel? Another one, Lennar Corp. DHI, D.R. Horton, he's buying it. Why is he buying that? It's a home builder. Lamar Advertising. And then what's he reducing? T-Mobile, Charter Communications, Liberty Media Corp, Apple, Bank of America. Those are tech. Some tech companies and some banks. Crypto is the lie that will inevitably catch up with you. Gold and silver are eternal truth. Now, David Bateman, billionaire, put in well over $1 billion into physical metals. And he bought the whole gamut. He bought gold, silver, platinum, and palladium. Crypto is the lie. What is that? They're using it to funnel money into crypto. They're trying to get you in it. And you know how they get the herd in there? Have it go up a lot. If it goes up a lot, people FOMO into it. It's a liquidity trap. It is a liquidity trap. And once they got you, you're in. Been saying good times for silver miners are coming. At the service, we bought the lows heavily in 24 and added early 25. A new phase in silver miners has now started. This is the bull market of a lifetime. Do not miss it. That is a more beautiful, that is a more than beautiful chart breaking out for SilJ. Another one from Grady. This chart is a proxy for the sector and it's showing the way. Underestimating this chart is not a very good idea. Large gold producer Barrick is still a laggard at present, but it has a setup, very big picture, which I think shows the potential here for the sector. Odds are very high that this is a massive pattern will play out, and it is now breaking out, so it is now happening. These kind of sector moves, they do not come around every week. So for heaven's sake, make the most of it. Plus, this time around, the sector move represents the monetary system going down. So it is not, it's the most important bull market there has ever been, ever. Here it is. Big move up, big consolidation. We're breaking out right here. So here we go. Barrick gold miners. Now, I'm not in Barrick. I'm in other stuff. And I've got an allocation, physical metals, and an allocation to miners. I am participating in what this is. I also think that there are other sectors that we need to be allocated to, or that I need to be allocated to. And it just so happens that Buffett is in a lot that I'm in. We have very similar holdings, just different holdings. Freight futures AM update, dry bulk, Capesize down 3%, Panamax is flat. Tankers both flat for VLCC and Suezmax. Here's another valuation one. The S&P 100 now has 27.2% of its total value in stocks that have a PE of at least 50. 50. There's only one company that has a PE below 10. Talk about overvaluation. So this is the S&P 100 PE ratio exposure. So 27.2% of the S&P 100 is in companies with a PE above 50. Look at history. Or no, this is the plot. Sorry, this is not history. This is a plot of where all of the PE ratios are in the S&P 100 right now. One company, Comcast, has less than 10. Whole bunch over 50. That's overvalued. With inflation data coming in hotter than expected, a quick reminder, inflation is fundamentally a monetary phenomenon. You don't solve it with a 7% fiscal deficit and a money supply hitting record highs. There's record levels of U.S. money supply. You don't solve inflation by running 7% fiscal deficits and increasing the money supply as much as they are. So what's going to happen here? Inflation. Inflation's coming. What happens to interest rates when inflation comes? They go up. What happens to the stock market when inflation or when interest rates go up? It gets a headwind and money starts to rotate differently. We've got, let me see if is this, I think this is one we've already went over. So that's all I've got for today here, guys. We're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special coupon code. And we'll catch you guys later. We've got a Q&A session on Saturday, 7 a.m. Mountain Time, where I'll answer your guys' questions through a Zoom call. But that's all I've got. So we'll catch you next time, guys. See ya.